Welcome to the ETF Show, taped right here at the Asset TV studios in New York. I'm your host, Kristen Myers, ETF Editor-in-Chief for Asset TV. Now, according to a February analysis by Morningstar, municipal bond funds are really having a moment. So listen to this. In January 2026, municipal bond ETFs brought in over $14 billion. That's their second largest inflow on record. Now, February flows weren't as strong, but the category still acquired nearly $11 billion, the third strongest ETF category by flows. Here to discuss more is Tom Casey, Senior Portfolio Manager on the Municipal Bonds Team at Insight Investment at BNY Investments. Tom, thank you so much for joining us
You're
today.
having me, Christian.
So you just heard those stats. It definitely sounds like there's a huge interest in these municipal bond funds. So let's look at the big picture. Really, how has the muni market performed in 2025 and then going into 2026? And what, trends or themes do you really think is driving some of that performance?
Performance has been excellent, and I think despite very heavy supply, we had $580 billion in new issue supply last year. The market performed exceptionally well. We were able to digest that supply with relative ease, and I think there are a couple of different reasons for that. One is I think we began the year at attractive valuations. The second is the diversity of buyer base has increased, and ETFs are an important part of that. We've seen broad-based participation from ETFs as well as individuals looking for SMAs. You mentioned flows this year have been certainly robust. Last year, we had $45 billion in positive flows into muni ETFs. The expansion of ETFs in the market, as well as their penetration or footprint, has been significant. And as it relates to the timing of that, in the fourth quarter of 2025, there were $20 billion alone. So we've really had an enormous, they've always had an enormous impact on the market more recently and have increased liquidity in the muni market, which has been excellent in both up and down markets. Transparency has been increased, and we think that that's a trend that's going to continue. Longer intermediate bonds did particularly well last year. In particular, 10 to 15-year part of the curve did very, very well. The curve is quite steep. Many ETFs are oriented out the curve. That I think is beneficial longer term in terms of the ability to extract value from the market. And credit quality is very good in the muni market, stable if not quite solid for most issuers. Now that's a broad-based statement, but I would say generally speaking, municipal credit quality is excellent in the muni market. We've seen upgrade to downgrade ratios continue to be reasonably solid, but have declined a bit. I think that's the part of the rating cycle we're in.
Right.
But municipal credit quality remains very, very good. And as I mentioned earlier, the relative value still looks attractive to us.
I want to dive into all of that in just a minute. But first, I'm going to go back to the supply. We've had a lot of new issuances. I'm curious to know really why, what's really been driving this increase in supply. And do you think, it may sound like it has because of the inflows that we've seen, essentially if demand's been able to keep up with all of that supply?
I think the ability of the market to digest that has been a component. I think the primary drivers are, if you think about the post-COVID environment where many projects were delayed or postponed, many of those are coming back online. And if you think about the inflationary costs of projects, the American Society of Civil Engineers produced a study where average borrowing costs for a municipal issuer is up about 70% over the last 5 years. So think about wages, think about materials. That is kind of artificially increased the new issue supply in our market. And given the receptiveness of the market, the issuers have continued to access it with a great deal of success. So I expect new issue supply to continue to increase. In 2024, we had an annual record that was eclipsed in 2025 at $580 billion, up about 14%. This year, we've had $103 billion in new issue supply. That's up about 3%. That's something that we expect to continue. The other element, with specific respect to 2025, there were concerns among some issuers about the access to the muni market. Higher ed would be one, hospital and healthcare, commonly referred to as private activity bonds. There were concerns that their ability to access the market would be reduced at the federal level because of the Trump administration's rhetoric. That turned out not to be the case, but many of those front-loaded issuance in 2025 then came to market. And that's another reason that issuance increased in 2025.
Now, you mentioned credit quality. Talk more about that, if we're, how the fundamentals are still holding up there.
Fundamentals remain very good. And there's a couple of different ways to look at that. We certainly believe that general obligation bonds has more sensitivity, to interest rate volatility and the costs associated with that. But if you think about municipalities, broadly speaking, they're dealing with higher wage costs as well as healthcare and other benefits. So that's placed a little bit more of a burden on those, but broadly speaking, their revenue base has increased quite significantly as well. On a localized basis, most of their revenues are associated with assessed values on residential real estate. Broadly speaking, again, residential real estate prices have increased. That's increased local GO's revenues. They've also taken the opportunity to set aside some of those increased revenues to rainy day reserves. Really good from a bondholder standpoint. And so I think the dynamics are very, very solid. As I mentioned, upgrade to downgrade ratios have probably slowed a bit. We refer to that as a normalization. We're at that point in the credit cycle where many issuers which have the opportunity to increase credit quality or be upgraded have over the last several years. And as a consequence, we think credit quality is very, very solid. There are exceptions, and it's a very idiosyncratic thing, but there are some specific credits that certainly have not enjoyed that increase in credit quality over the last several years.
So when you look at the muni market, where are you seeing some of the best opportunities, right now?
We love essential service revenue bonds and having a really significant core of essential service revenue bonds in a portfolio. Think water and sewer, transportation, toll road, utility bonds. Those offer significant yields. Credit quality is very, very good. A lot of those would broadly be characterized in kind of the A-rated quality area of the quality spectrum. We think those are fundamentally undervalued. They have an essential service nature to those individual bonds. They have a revenue picture that's easy to analyze. They tend to have monopolistic power over a service area without the need for voter approval. They also have professional management, and what they don't have, that general obligations have, is they don't have these long-term OPEB liabilities associated with a large employment base. They are plant and equipment intensive, and as a consequence, they also tend to be undervalued, underappreciated. And if you think about munis being dominated by the retail investor, a broker traditionally would sell a bond to a retail investor. They don't have the credit experience nor the staff to understand the individual credit quality. It takes a lot more time to analyze a revenue bond, and as a consequence, the investors are more familiar with general obligation bonds. They live in the town, they've driven through it, they know the state. It's much easier to sell those bonds. So general obligation bonds in aggregate tend to be overbid, higher priced. We think that they're effectively maybe overrated, whereas
Right.
revenue bonds are underrated.
And talk about the portfolio positioning for those revenue.
Sure. We devote approximately 80% of client portfolio, 75 to 80% to revenue bonds, trying to take out a lot of the buyer base that traditionally loves general obligation bonds, and then building in a diverse pool of instruments that have good correlations with one another. And as a result, the revenue base is quite distinct, and you don't get the volatility you get with economic conditions that you were with a general obligation bond, either a state or a local GO.
Okay, so you mentioned liquidity. It's like one of my favorite things to really talk about now, particularly when we talk about ETFs. So obviously it is a huge piece when we're talking about the muni market. So how would you describe the liquidity environment right now?
Liquidity in munis is always different than other asset classes. It's never as good. It's never as transparent. But that represents enormous opportunity. Liquidity has been greatly enhanced over the last several years, and there are a couple of different factors. One is the penetration of retail investors owning bonds on an SMA basis. The second is algo trading on the sell side firms, which now have the ability to bid on large blocks of bonds in smaller denominations. And that was always an area of the muni market. Smaller denominated bonds, smaller block size, always received a pretty significant discount. That's significantly decreased over the last several years. And then ETFs that you alluded to, Kristen. ETFs are in the market, and when they get flows, they have to invest, broadly speaking, in a relatively quick period of time. And similarly, they also sell bonds when they're getting outflows. That volume and the progression and growth of ETFs has created a big buyer base that buys index-eligible bonds, broadly speaking, and that's increased liquidity to a large degree on both large and small blocks of bonds. So they've been a great participant in the market, a welcome participant. I do think there's enormity of opportunity in terms of the inefficiency of the muni market, but certainly they have wrung a little bit of that out of the market.
Right. So talk to us a little bit about why the ETF wrapper has such an advantage, in accessing the muni space.
I think that we call it the 3 T's, which would be certainly tax efficiency being one, trading and transparency. I think all of those are elements of an ETF portfolio or an ETF allocation that are a bit different than the other ways to access the muni market, i.e. through an SMA or a traditional mutual fund. All of those are beneficial from an end user or a shareholder standpoint. And I think that that's advantageous to be used as a standalone product or as a complement to traditional municipal exposure. You might be able to bundle a traditional SMA portfolio with perhaps an ETF that takes a little bit more risk and maybe a little bit different part of the curve, which I think is a unique advantage and a unique opportunity in the muni market.
So BNY has a whole muni bond ETF lineup. How should investors, really think about your muni bond suite and where those strategies are really fitting in their portfolios?
We have three distinct products within the ETF space. One is a short duration bond fund. The second is an intermediate, and then the third is the opportunities fund. And short is a high quality alternative oriented to the front of the curve. Not surprisingly, intermediate portfolios in the intermediate part of the curve, both of which have a very similar characteristics in terms of their allocation to credit, sectors, subsectors, and individual securities, but they are oriented in a little bit different parts of the curve. The way that I view those is it could be either your opinion on the directionality or move in interest rates, or your comfort level or safety, how safe you feel about having an intermediate versus a short. But I think that they are pretty complementary products, just oriented in a different part of the curve. And then the opportunities fund has a lot more flexibility in terms of sector orientation, quality, as well as its exposure along the yield curve. It will take more tactical opportunities in terms of the shape of the curve or perhaps even duration. It does have the ability to augment that. Because of the unique steepness of the muni curve, it tends to be oriented out the curve. Has a lot of flexibility in terms of average maturity, but it tends to have a significant amount of assets oriented out the curve. So it's longer maturity, offers a lot more yield. Oftentimes we'll have exposure to some lower quality credits relative to the short or the intermediate offerings.
All right. Tom Casey, Senior Portfolio Manager at Inside Investment at BNY Investments. Thank you so much for joining us today. And thank you for tuning in to the ETF Show.